You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for industry happenings.
We continue to get lots of options-related questions from our listeners, so we'll take a few in today's Industry Happenings segment. Goose asks, what's the difference between weekly options and standard options? Well, Goose, the key difference is time. Standard options are those options that expire on the third Friday of each month. Almost all listed options have a standard expiration cycle with the third Friday as expiration. Weekly options, on the other hand, expire the week after being listed. Now, only about 15% of listed options have weeklies. It's about 650 products. It's probably worth noting that when you really think about it, every listed product can be viewed as a weekly option at some point in its life. With the standard options, that weekly expiration only happens once a month versus every week. The listed options obviously have a weekly expiration. Next, Bob asks, I've been told to take an at-the-money call and an at-the-money put at earnings time, add them together, and that's the expected move for the underlying on the earnings announcement. Is that correct? The short answer, Bob, is yes. That at-the-money straddle price is the market's forecast for movement on the news. Another aspect of this straddle analysis before earnings is getting familiar with options premium levels or the all-important implied volatility levels. It's a good idea and easy to do some implied vol homework before earnings by going to our website, optionseducation.org, and investigate implied volatility charts. They can be found in the drop-down bar under Tools and Resources. With that chart, you get a sense for how low or high previous levels of implied volatility have been over the last year, and you can pair those levels up against previous earnings announcements. Speaking of straddles, Lesnut asked the following question. How do you get out of straddles? One side of a straddle is always a loss, correct? First, let's be sure everyone knows what the straddle is. It's a position with an at-the-money call and an at-the-money put. A long straddle is a long call and a long put, and therefore a position with long implied volatility. A short straddle is being short the at-the-money call and put and short volatility, but with that short straddle comes unlimited risk because of the exposure of that short option position. Usually, one side of the long straddle position will incur a loss because typically the straddle is initiated because the investor is looking for a really big move in the underlying stock. If the stock moves big, up or down, the value of one side of the straddle will decrease. These big moves usually happen after some corporate announcement such as earnings. Now, there is an exception, though, to one side of the straddle taking a loss, and that's when option premiums expand when implied vols increase without a big move in the underlying, or maybe prior to the corporate announcement. So it is possible to have the value of both the call and the put expand with ever-increasing implied volatility levels without the underlying moving. That's actually just the implieds going from a low level to a higher level. Without a big move in the underlying, you can see both the value of the call and put increase. So thanks to Goose, Bob, and Lesnot for today's questions. Keep them coming. That's today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Bill Ryan from New York Stock Exchange Options. Bill, thanks for joining us today.
Thanks, Joe. Thanks for having me here.
It's always good to talk to you about options. I know you get out, to the public representing OIC all the time out there on the seminar path. So we appreciate you doing that for us for sure. Today we want to try to focus on this whole idea of options and corporate earnings announcements. You think options and earnings announcements go together, Bill?
Yeah, I mean, there's an opportunity when earnings announcements come out to make some money, and options are the perfect vehicle for individual investors to make money in a short period of time for just such an event.
Well, how about if we, maybe go through an example or two, and maybe if we, talk in terms of a full earnings cycle, maybe. Well, why don't you take it away? Whether you want to start 4, 5, 6 weeks out or something a little closer. How do you like to approach corporate earnings and options?
Well, Joe, I think there's two different ways of looking at it. And if we take a stock that we've been following for a while, maybe one that we own, or maybe one that we just like to watch, and we know what the cycle looks like. We know what happens every time earnings come out. We know when it's going to come out, which we should at any stock we're looking at anyway. And we may notice that over a period of time that the volatility in the options increases, the implied volatility increases during the lead up into earnings. And if we look at implied volatility, we know that higher implied volatility gives us higher option prices, and lower volatility gives us lower option prices. So we may look at a stock that we know we've been following, we see what happens with it, and we go out, 6 weeks or so, maybe 7 weeks. We buy an option out that far, and we watch that volatility increase. And with that volatility increase comes an increase in our prices. So we may get in early, way ahead of the earnings, and then get out right before earnings because we know that after earnings, the volatility is going to drop. So we can look at a volatility cycle like that. We can look at what's going to happen 6 weeks, 7 weeks ahead of time, get in before the volatility increases, and get out right before it decreases. Now that's one way of looking at it. Another way is to look at it a little more short term. It's not really a stock that we know too well, but we want to get in and look and see what's going to happen with these earnings. We're looking at some news reports. We think it's going to be good earnings. We know volatility is high, so because volatility is high right now, prices are high. So it may give us a chance to get in and say, oh, it's high, but it's going to go higher. But a lot of times we worry about the volatility coming back down again, and that's going to be a different situation.
Okay, so we're basically talking about volatility plays. When you do that, Bill, you're talking about like the idea of a straddle or strangle, the straddle being where you buy the at-the-money call and put, or the strangle where you're buying the out-of-the-money call and put. Is that what we're talking about with these plays 6 and 7 weeks out?
Well, 6 or 7 weeks out, I think if I was going 6 or 7 weeks out and I follow an earnings cycle and I think that this is going to be, the next, product is coming out and it's going to be great, I think I would just buy the call. I think it would just go as simply as buying the call. Now, if I didn't know or I didn't suspect, but if I didn't suspect that it's going to go one way or the other, but I thought there's going to be a big move, then I would buy the straddle or the strangle. Now, the situation with buying the straddle or strangle is that we're expecting a big move either up or down, and that's going to be expensive. It's going to be expensive, and we have, wider break-even points for the straddle and the strangle. So we need a big move in the stock. The volatility is going to go up before earnings. So if we buy the straddle, it's going to go high, and we can sell that straddle right before. And instead of buying just a call or a put, we've bought both, and we make money on both sides, the call and the put.
Okay, so we hope that the natural theta loss in a long option position will be offset by a greater increase in implied volatility leading up to the earnings announcement. That's basically what we're talking about. Yes?
Yeah, I didn't mention the theta part of it, only because we're concentrating on the volatility aspect of it right here. But anybody that uses options knows that you have to follow the Greeks and pay attention to both these. And also, we don't mention commissions in here either. And if you buy that straddle or strangle, you pay a lot of money for that straddle or strangle. You have to make sure you cover your commissions on the way in and the way out as well.
Okay. Well, before I get into kind of the delta one directional plays, just a last thing on volatility. If investors and listeners want to check out where implied volatility levels have been, for previous earnings announcements, can they find? Are there volatility charts out there?
There are, and there's a couple of private companies that have them. iVolatility.com is one. I think you can get the historics probably from most brokerage houses. You can look at historic volatilities, but you got to do a little research on that and find out where you get it from and what they're showing you, and make sure make sure you understand what you're looking at before you rely on those.
Okay, and I'm pretty sure at optionseducation.org under the tools and resource bar, we'll be able to find those implied volatility charts too, just as another possible resource.
How could I forget them, Joe? How could I forget them?
I just tried to sneak that in there for you, William. Let's go now. Okay, so we're talking volatility plays, maybe number one, and you mentioned possibly just getting along the call, which would really be more of a directional play, I think. Do you have a favorite approach, pre-earnings in terms of directional plays? Do you do spreads? You do, just single option positions? How do you like to do things?
Well, I like a spread, and let me tell you why. We talk about volatility and prices rising when volatility rises and falling when volatility falls, and there are a lot of people out there who believe that you sell options when volatility is very high, and sometimes this works. Volatility is very high. You sell the option, volatility comes down, the price comes down, you buy it back cheaper. But that's a very risky strategy, and I would never recommend that to anybody, especially with a short call. A short put, you can manage that risk. It's defined to the strike price minus the premium you bring in. It's like owning stock. But selling naked calls is just way too risky for the average individual investor, not something I would ever recommend. But because I like the idea of selling that volatility up at a higher level, I could buy the call buy the in the money call, sell the out of the money, get a little volatility, or maybe you buy the in the money and sell the slightly out of the money, depending on how you really feel. But I'm going to sell a call and sell some of that volatility to offset the call price, the buy call price. So I'm getting this little bit of upside cheaper by selling that call. So I like doing the call spread there. And as you know, if you do a call spread, you have a limited upside potential. We're doing this for earnings. We're not doing this for long term. So I'm not so concerned about what's going to happen 6 or 8 months from now. I'm concerned about what happens the day of earnings and the day after earnings. So I think a spread, a bull call spread, if you think the stock is going to go up after earnings, is a very good play here.
Okay. And if you think the stock may be heading south, would you consider the put vertical?
I would absolutely look at the put spread. You
Okay.
buy that put spread, and if the stock goes down, we can make a little bit of money.
And, if we thought the stock was just going to kind of hang around and not do much, would you consider, the horizontal or time spread?
Well, I like the time spread. I like the time spread for two reasons. Number one, I could have that spread make some money on the earnings, which would be a great place to make money, and then I still have the long side going out further than the short side, and I can make a little money just by being bullish there. So I have the earnings, I make some money on the short term with the earnings, and I still have the bull spread. The bullish position on the long call, and I can make some money there as well.
Okay.
So two places you can make money there.
Well, very good. How about, and so we've talked about, and you mentioned how important kind of tracking the Greeks is when you're talking options, and, preceding a corporate announcement, all that more important to know the dynamics that are driving your option premiums. We've talked, volatility plays, delta plays. Anything else, Bill?
Well, you know what we didn't talk about, Joe? We didn't talk about the type of stocks we do this with. When you look at the stock that you're going to do this with, if it's a stock that you understand, you've had for a while, you can track it and you know what's going to happen. But if it's a stock that you're not familiar with, you have to make sure that there's a lot of some premium in here. We can make some money. Then the stock has the ability to move. Big cap stock, large cap stocks like, an ExxonMobil or something, probably is not going to move much around earnings because the earnings are not going to be any kind of a surprise. Volatility is going to go up a little bit because it always does, then it'll come back down again. The markets are very tight in those options. So you want something that's a little less than, a large cap stock, I think. You want to come down a little bit to a mid cap stock, one that has the ability to make money, can be a surprise here and there. And the option spreads are a little bit wider, so we can get in the middle of them, but they still have volume in the option world, and they have open interest in the option world. So you got to pick a good stock and a good option for this. And
do you have any sense for, or when you're doing this, how many positions do you like to have maximum at one time? Well, that's a very personal thing for an investor. I mean, if you're following stocks, you're probably only following 3 to 5 that you're really good with. And if you're going to do this in the option world, track a couple of them. I wouldn't go looking at, 15 or 20. You're just going to confuse yourself. Look at 3, maybe 4 different options, and, really concentrate on the Greeks there, really concentrate on the stock movement, and, follow those and use those 3 or 4. Very good, Bill. Well, it's always a pleasure to talk to you. And for your listeners, keep an eye out for Bill. As I said, he is one of our, great OIC instructors who visits cities across the U.S. with our live educational program. So, Bill, as always, thanks so much. My pleasure, Joe.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
I'm happy to welcome Jill Malandrino, Global Markets Reporter at Nasdaq, to our Profiles and Perspective segment today. Hello, Jill. Thanks for joining us.
All right. Well, thank you for having me on the show.
Now, Jill, I know you got a long, deep history in the financial markets. Can you tell our listeners maybe about your career path before joining Nasdaq?
It's really interesting because my career has evolved just as markets have evolved. I waltzed onto an equity trading desk in 1998 on the retail side and moved over to the institutional side. And for most of us out there who have been either on the sell or buy side, there really is nothing like the camaraderie that a trading desk offers and all of the skills that you learn from a financial perspective and also as a community perspective. And as the markets evolved in 2008 with the financial crisis, the last trading desk that I was on, they decided to close the equity division, and then I evolved into the media side. So it's a definite bonus having the financial and trading background and then taking the personal skills that I'm continuing to hone in on and run a media product that is just leading the way here over at Nasdaq.
Amen to that, Jill, which leads me actually into the next question. You are clearly now with Nasdaq as the global markets reporter. How did that come about?
Well, it's really interesting. I have worked with Nasdaq before when I was over at thestreet.com. We've done a lot of cross work together. So it truly has been an honor to officially be part of the team. I joined on in March of 2017 to host the show that we called Trade Talks. We launched on March 9th, 2017, and just in a few short months, we are the #1 social program by far over at Nasdaq, and that's something that my team and I are incredibly proud of. Our main focus is on options and derivatives-related product, but if it has a market and it trades, we are absolutely covering it. Everything from commercial real estate to equities to fixed income to even luxury investments, because all of our markets are intertwined, and that's something that we take seriously here. And there's always a story to tell in finance as it relates to the market. So there's so many uncovered stories out there that we are looking to spearhead.
Well, Jill, that background you mentioned, coming from the trading desk and then evolving onto the communication side and with the power of Nasdaq, really a fantastic combination. You're focusing on a lot of different areas and really options specifically. Tell me a little bit about who you're working with over at Nasdaq on the team.
Well, we work with a number of people on the marketing communications team based out of Nasdaq over in headquarters. And we also work with our team over at the Philadelphia office, which many of you will know we just relaunched our trading floor in April. So we have the Nasdaq PhilX options trading floor over there, which is fantastic because we are a live, full open outcry and electronic trading floor. We broadcast from there every options expiration Friday. And not only do we have the opportunity to meet with the guys on the floor there and actually listen to live action going on, we bring in a number of guests with us on the options and derivatives side, including portfolio managers, analysts, other traders. And we're also making headway into the registered investment advisor and financial advisor area. So every options expiration, it's a different format, it's different guests, so we really are getting incredible depth that you're not going to get anywhere else in the media world, particularly with the exchanges.
Well, you mentioned Philly, and that's very close to my heart, having spent 23 years on the floor of the PhilX. It is wonderful that Nasdaq obviously acquired Philly a long time ago, but they've made the commitment to, open the new exchange. Is very, very exciting. It's very exciting, and also broadens our commitment to Philadelphia, and it's a city that's very near and dear to us. And the new trading floor in the office itself is fantastic. It looks like you're walking into an Apple or a Google office, which is great for attracting new talent and really giving an exciting backdrop to grow this media program that we have. And of course, Joe, you and I, coming from the options and equity world, when you actually traded in paper and fractions, it is really nice to have that open outcry experience as well. It gets our guests fired up. The feedback that we get from our listeners is exciting. We have people writing into us on social media asking to join and participate. So it's something that's taken off in just a few short months, and sky's the limit as we see it. Well, Philly's always been underrated, but, you'll help to get it even more on the map, I'm sure. Now, you mentioned fired up, Jill. When I think of you, I do think about how fired up you are about options. Why? What's the impetus for that? You know what I love about options are you have your equity traders, then you have your options and derivative strategists, and those are really the smart people in the market. If you think about it, options, it's a future-looking product.
So it gives you clues into what traders are anticipating, whether it's price movement, vol movement, and it's more than just looking at what's happening in the equity world or what's happening in the research world. And that's where you get your smartest group of traders. So doing what I do for Trade Talks, I talk to the most brilliant people in the U.S., and we're also expanding into Europe as well. And, these are the people that are doing homework on much higher levels. And the other great thing with options markets as well, and for those of us that are trading through a low vol environment right now, or this market that's been in a significant uptrend over the past 8 years, options traders, they're going to make money, or at least have some market perception, whether the market's up, down, or sideways. So options inherently give you options, and that's why I love covering it. That's why I love trading them. It always gives you something to talk about, and that always gives you the edge over other people who don't necessarily incorporate it into their trading plan.
Well, your enthusiasm always comes through, and I appreciate that a great deal. You mentioned market volatility levels. With all the people you talk to, is there any consensus out there about the direction of implied vols?
Right. Well, the general consensus is, are we ever going to get sustained volatility back into the markets? It certainly has been a frustrating 6 to 12 months to trade for sure. Options traders, equity traders, even bond traders for that matter, you need that volatility so that you can look at different price levels and consistently come up with new ideas. It's really interesting that you're seeing in mainstream media right now about this whole selling of vol and how people are employing those type of strategies when, and Joe, our good friend Skip Rashke would say, selling vol is like picking up nickels in front of a steamroller, but that really has been the strategy that has been consistent over the past 12 to 18 months. It's really interesting if you take a look at the exchange traded product world, that most of the inflows and the growth is really based off of these VIX-derived ETFs and ETNs. So that tells you how much volatility is getting into the mainstream. So I'm not sure if we're at an inflection point right now. If you take away what's happening on a geopolitical level, the markets, the equity markets in particular, are actually doing quite well. Economic data is continuing to improve. Corporate earnings have been better than they have been in years. So there is that support from a fundamental perspective in the market. But really, the big question is, when will we see sustained vol back into these markets? September's notorious for that. We'll see what happens in Q4. The debt ceiling was pushed off to December, so perhaps we'll have some later vol at the end of the year. But there are a number of forces at work right now. So the question is, are we at an inflection point, or is it more of the same? I personally think that we might see a little bit more action. Again, there's a lot happening on the political level going into the end of the year. And then, of course, you always have the holiday season coming up. And markets love to talk about that and how sales are doing and the strength of the consumer. And then we also have employment reports will also come into December. Will we get another rate hike? So there really is a lot on the calendar for traders to work with. So we'll see if that, in fact, does play out.
Amen to that. And that really, to me, has always been the wonderful thing about the markets. They're living, they're breathing, they're incredibly dynamic, and all of those different aspects that you just mentioned, make it, such an interesting living being. And, that's why it's so much fun to trade. And by the way, thanks for the Skip reference. I'll be sure to let him know.
Yes, we have to send that to him.
Indeed. So one other thing I wanted to ask you about the options market itself. We've had wonderful growth that was really in the early 2000s. We average in the neighborhood of 16 to 17 million contracts a day, which is, pretty darn good given where we came from. We've kind of stagnated at that level, although, I don't really view it that way. I think we've maintained those levels in this, really very low, some would say extraordinarily low volatility environment. So I think that's constructive. That being said, do you think, is there growth potential in the options market, or do you think there's, reason for concern?
I absolutely think that there's growth potential there, without a doubt. And as you had mentioned, we are seeing slight improvement in the volume data. And I also think there's a big market, and this is one thing that we focus on for Trade Talks, particularly when we're in Philadelphia broadcasting for options exploration. There is a tremendous market of registered investment advisors, financial advisors that education media is really not geared to. And as the volume leader with all the options exchange, Nasdaq takes it very serious to fulfill that vertical. And I certainly think there's a ton of growth there where it hasn't been focused. Registered investment advisors, I think now more than ever, are looking to incorporate option strategies within their portfolios that they manage for their clients, because where else are you really going to get yields from? And you know, another reason to incorporate options is look at the run that this market has had in equities. You certainly need to hedge those positions and protect those gains. So I think that is a vertical that really needs to be focused on. There is certainly growth there. The recent survey that came out over the spring shows that 30% of RIAs are using options. There's a 70% that is not. And that's a market that we need to aggressively offer that education and provide tools for. So I think that's really an area that we should be focusing on for sure.
And do you think you can get to that 30% in the next 30 days, or excuse me, that 70% in the next 30 days?
In the next 30 days?
I'm just teasing.
If I could make that happen, I'd be living on the island of Jill and not hoofing it to work every day. But yeah, I certainly think that's where the growth is. And we're also seeing, and we've spoken about this before, and I've seen a number of studies through TD Ameritrade. They have a big millennial data set that they follow. Millennials love to trade options, and they love to trade stocks that they know, right? So like Nasdaq listed Facebook or Apple or Netflix. We're seeing a lot of volume come from that, and millennials are the biggest consumers. They are really driving just about every industry in terms of what's next. So I think if you have them incredibly engaged with options and you also focus on RIAs, that those are two verticals that I don't think enough attention has been paid to. And once you get them involved, you could really see this take off more.
Well, Jill, it's always a lot of fun to talk to you. You bring so much information as well as enthusiasm to the table. Would you just, before we wrap it up, would you tell our listeners how they can follow you?
Sure. They could follow me on Twitter, Facebook, and LinkedIn at Jill Malandrino, Malandrino. We always love to hear from you. Certainly follow me, send me your ideas, ask questions. If you're ever in Philadelphia or you're in the New York City area and want to join us and see what the studio's like at MarketSite or on the trading floor, just let me know. We always love to have guests come and check everything out and offer their ideas.
Fantastic, Jill. Thanks so much for joining us today on Profiles and Perspectives.
Thank you.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, I'd like to start out by introducing tools and resources offered in a recent OIC webinar. We invited Cboe Vest, Options Play, and Stratify to all demonstrate some of the dynamic analytical tools they offer. That OIC webinar was called Tools of the Trade, How to Find the Best Option Series for You. That can be found on the OIC's YouTube channel or on demand. Now, you can also visit the firm's websites. Those websites are cbovest.com, that's cboevest.com, optionsplay.com, options with a plural, and stratify.com. That's STRATIFI.com. Again, the name of the OIC webinar was Tools of the Trade, How to Find the Best Option Series for You. Check it out, again, on demand or on the OIC's YouTube channel, and explore the very latest option technology tools. Finally, today's good read is from Michael Coe and Mark Gunther. Their new book, The Options Edge, an approach to generating consistent profits for the novice and the experienced practitioner. Mike and Mark are really smart guys who have been in this industry for a long time, top flight pros who really know what the heck they're talking about when it comes to the options market. So check out their book, The Options Edge. That's today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back segment, I'd like to take us back to 1992. That's actually the year the Options Industry Council was formed. We're about to begin a year-long celebration of our 25th anniversary. In 1992, it was the OCC and the exchanges who decided to pool resources to create an educational arm for the industry for investors to offer them a better opportunity to get to understand the benefits and risks of listed options. Industry volume in 1992 was just over 200 million contracts for the entire year. And perceptions among investors about listed options was, I'd say, mixed at best. Now, 25 years later, annual industry volume typically exceeds 4 billion contracts with individual investors, financial advisors, and industry professionals using the product for risk mitigation, income generation, as well as other applications. Now, if you've never visited our website, I invite you to go to www.optionseducation.org. Take your time, because there are lots of ways to familiarize yourself with options if you're just getting started, or to increase your knowledge if you've actually been using options for a while. That's optionseducation.org. One item actually I'd like to kind of guide you to on the site is called My Path. It's a series of options lessons that we download to you after you take a 20-question assessment test. That's My Path, and again, you'll find that at optionseducation.org. Happy 25th anniversary, OIC, and here's to many, many more. That's today's Looking Back.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.